What is going on, traders? Welcome back to the Traveling Trader, another edition of TA Thursday. As you guys know, we started this really at your request, TA Thursday, TA Tuesdays. We didn't do one on Tuesday, but this happens to be Thursday, and I didn't want to let another week go by without doing it. So let's just dive right into it. We talked about in the last TA session that the SPY was forming this ascending wedge pattern. And this right here, this fair value gap that was really formed by taking the low of this candle here, this green one, and the high of this candle here, the one following this big red one. This created a huge fair value gap on the 1 day. I'm not really a very strict fair value gap trader. I just have them up as an additional point of reference when I'm trying to look for support and resistance. And as I was saying in the last video, that because this coincided with September 13th, right, with the basically what was the CPI date, and you could see here, this right here was the CPI day on September 13th. And as I was saying, that if the inflation report came in much hotter than expected, as it did, then we will likely see this acting as major resistance and we would not get above this gap. So in this case, the technical bounce here can grab liquidity at this level, at this imbalance level. And this is where we would likely see a first major test. And this would coincide with September 13th with the CPI data. However, if inflation is coming in, comes in as expected or even higher, then I think this will be a major point of resistance for the market right here. In that video, I said that we wouldn't get above 415, which was really near the top of this gap here. If the inflation report came in hotter than expected, we came in at 8.3% year over year, as you guys know, versus an expected 8.1%. Not only that, but headline inflation rose 0.1% month over month, even with falling gas prices, and core inflation rose 0.6% month over month. So not only a hotter than expected year over year reading, but month over month, we didn't, at this point, we should not expect to come in higher than previous months if we are tackling inflation, or the Fed is tackling inflation properly. Clearly, what they are doing hasn't taken effect yet. And that's because usually Fed policy takes a long time to hit the economy, right? For it to be reflected in the economy, which is why they should have started this a while ago. So we might not see the effect of these back-to-back 75 basis point rate hikes for a while, or of the Fed balance sheet being rolled off, or they're rolling off $95 billion a month in assets. So back to TA, this was a purely technical bounce, as we described in the last video, off of what we call the golden pocket. The golden pocket is between the 0.618 and 0.65. If I was going to draw this again, just for reference, I'll show you how I got that. Basically drawing from the lows, the swing low here, which was the June 17th low, to the swing high here, which was on August 16th, because we are measuring this drawdown here, right? When you're measuring this drawdown, you are aiming the 1 or the 100% on the Fibonacci on the bottom and the 0 at the top, taking into account the most previous swing low and the most previous swing high. And so when we're starting to basically measure this drawdown here, you're measuring it against this range, and we see that we stopped right at what we call the golden pocket between 0.618 and 0.65. And as I told you last time, in order to get that 0.65, you're going to have to go into your settings and add it manually. It is not a natural Fibonacci number like 0.618 is. So you're just going to have to pick a box, any one of these boxes that are not in use, and type in 0.65, and that's how you're going to get your golden pocket. But you'll see, if you start drawing these Fibonacci's properly, time and time again, you'll see that the golden pocket is a very significant point where we usually see heavy support or heavy resistance, and either a continuation or a rejection, either a continuation after consolidation or a rejection or bounce from those levels. But this right here was exactly what we had expected if the CPI numbers came in much hotter than expected. I think that there was a chance we could have broken to the upside and at least tested this high here and maybe tried to close this gap that we formed between August 19th and August 22nd if CPI came in, much better than expected. But obviously that wasn't the case. And we will now likely see a very aggressive Fed on February 21st when we get either a 75 basis point rate hike or a 100 basis point rate hike. But for me, as I said in the Discord, as I said in the private trading group, I will likely open up another doomsday portfolio, which is what I call it. Basically, I opened up a whole portfolio worth of puts, worth of long dated puts, and we took advantage of some of this drawdown here and then closed it once we started bouncing off of this golden pocket. And I would likely open up another one. I could have opened one up right before CPI, but that's a binary event and could have went either way, meaning that if CPI came in better than expected, we could have seen a rally that would have completely obliterated those puts. So for me, it wasn't an optimal play. Would have been a good gamble, yes. We certainly day traded on this day, but buying a whole bunch of puts before a binary event is just like playing earnings. It's it could go either way, and you basically have to be Nostradamus in order to guess correctly. So in this case, what I'm waiting for is confirmation that this pattern is broken, and we are now getting a break below this descending wedge. As you know, ascending wedges tend and ascending channels tend to break to the downside eventually as this support level gets tested. And we have not moved this line. This line has been in place, since I drew this pattern. If you look at the last video, you'll see that. But we are now getting a break below, and for me, I will open up another round of puts heavily if we break below the golden pocket, which on my chart is around 386-ish. So if we can break below this level here, then I will likely open up another round of puts in order to take advantage of this move down to the downside, or I will short it using futures. The difference between futures and options obviously is that futures don't have things like time decay, implied volatility, IV crush, all that stuff does not play a part in futures. And sometimes it is a lot easier to hold short positions that don't get that don't have a shot of getting beaten up by theta decay, by IV crush, by increases in price, right? Like, or even stagnation in price. If you open up puts here and say the price just kept trading sideways, because of theta decay, those puts are going to get obliterated, even though there haven't been any significant movement to the upside. Whereas if you held a short on futures, and it trades sideways, you can essentially hold that risk free until, or not risk free, but you can hold that payment free or cost free until you get the move that you want, right? So it really depends on how fast you expect things to play out. And you can utilize a barbell strategy where you're basically playing options and futures as well. To each their own, but there are many different ways that you can actually short the market. You can even use inverse ETFs, something that I don't prefer to do, only because they are leveraged ETFs, not really good for holding for the long term, because of that leverage factor, right? So anyway, let's take a look at the Nasdaq, and see where on the Nasdaq I would open up puts. One thing that I wanted to point out on the SPY, actually going back to the SPY, is that we didn't have this last time when I did the TA video, I don't think, but right now we not only have a break below the descending or the ascending wedge, but we have a clear head and shoulders pattern here, right? And this is a very bearish pattern, especially when you see it after a rally, right? So when you see it coming from a drawdown, then a head and shoulders pattern has less less of a chance of being bearish. But in a rally like this one, since we've had since June 17th, we are now seeing a huge head and shoulders on the daily and a break below the ascending wedge. That's just another point of confirmation that if we break below that golden pocket, we will likely retest these June lows. And if we take a look at the triple Qs, it's almost the same exact pattern, right? Where we are now breaking below that descending wedge. And the triple Qs, the reason that I shorted the triple Qs heavily last time as opposed to the S&P 500 is because the triple Qs, or the Nasdaq, is way more tech dependent than the S&P 500. And mega cap tech is a lot more sensitive to rate hikes than the S&P 500 is, because the S&P 500 contains a wider range, a wider basket of stocks, and heavier weights in those non-tech sectors compared to the Nasdaq. So the Nasdaq is a lot more sensitive to rate hikes, and that's why lately you're seeing way bigger moves in the Nasdaq than you are in the S&P 500. So yeah, looking at the Nasdaq, it is basically the same pattern, and I will likely open up puts on the Nasdaq as well if we get below 290 on the triple Qs. That is when I'll start opening up heavy puts. But for me, if we break below 290 on the triple Qs, if we break below 386 on the SPY, we are almost certainly retesting those June lows. And whether we get below the June lows or not is going to be dependent upon what happens with the economic environment as it relates to a recession. Are we going to get a broad-based recession? Is the Fed going to ease up or pause or pivot at some point if the economic data gets really bad? It's really going to depend on that. The market is very Fed dependent. So once we retest those June lows, if we are, say, in a broad-based recession at that point, unemployment is ticking up and it looks like the economy is going to tumble upside down, then the Fed at that point might pivot, and it would be dangerous for them to be very aggressive in an economy that is slowing to a halt. So it really depends on what happens. But I do think that if we break below those golden pockets on the daily, then we are retesting those June lows, and I will have hedges in place in order to take advantage of that. And if you want to track my trades in real time, if you want to see what we're doing with the doomsday portfolio, which puts we're opening, how we're shorting futures, we're also using these exact same principles on our futures day trades. You can see here that we took the short on the NQ right at the golden pocket as well. There were a bunch of other confluence indicators here, but this was over a 200-point move in the futures, which would have netted you on the NQ futures contracts around $4,500 per contract if you took the short. But we're using the same principles that we are using when we're doing TA, broad-based TA as well. But if you want access to these day trades, to the doomsday portfolio that I'm about to set up, and I will also be starting another portfolio when I feel comfortable investing again. Right now, until we hit close to those June lows, I don't really feel comfortable buying large amounts of stocks. However, we might sell cash secure puts. We are definitely selling covered calls here on Apple, on Tesla, on the indices, making money on some of those holdings that we currently have by selling covered calls. But if you want access to all of that, the chat, the Zoom calls, the courses, the day trading course, the options course, the Zoom calls with me, link is in the description below. We just opened up spots for September after they ran out in August. So if you want a chance to snag a spot, click that link in the description. And let's go back over the TA here. One other thing to keep track of here is the Fed balance sheet. I know that this isn't TA specific, but I talked about this in my video yesterday. As the Fed starts rolling off assets off their balance sheet, what is that going to do to the markets here, right? Because now you have a two-pronged aggressive approach where we're getting rate hikes and rolling off of assets from the balance sheet. So for me, again, breaking below golden pocket will most likely have us retesting those June lows. And at that point, I will probably look to start investing pretty heavily, as some of the blue chip stocks are going to be at that point 30 to 50% off, drawdowns that we haven't really seen on blue chip stocks except for a blip back in June 2022. Now let's go larger picture. Larger picture on the Nasdaq or the triple Qs is even more bleak, because when you switch to a weekly chart, it's one thing to see bearish patterns on the shorter term charts. The 1 day is a pretty good overall chart, but once you start seeing this stuff on the weekly charts, then it is a much more significant indicator of potential drawdowns. And you can see that if you look historically, patterns play out very well on the weekly chart on the larger time frames. Like we have the bear flag here. Obviously you had if you look at this at the top of here, you had a head and shoulders at the beginning of the year, which led to this drawdown that we are now seeing. You have a double top back here. You have another double top here. So patterns on the weekly chart are usually way more significant than they are on the lower time frames. And the fact that we're now bear flagging on the weekly chart, again, if we break below that GP level on the daily, then it will obviously be a break below this bear flag here, and this bear flag will be confirmed on the weekly chart. And where we would go from here, if we did start breaking below below this bear flag on the weekly, or below the golden pocket on the daily, then the next logical support point would be the June lows, which also coincide with the support level from September, October 2020. But if that is broken, if we break below the June lows, then the next natural and I think psychological level would be the pre-COVID highs, right? Everyone will be looking at these pre-COVID highs and saying, the entire market will be targeting this, the algos will be targeting this, because the pre-COVID highs are really the last sort of flashpoint before the hysteria of the 2020 bull run that started in March 2020 and was really driven by inflationary monetary policy, right? This is back when, I don't want to say when the market was rational, but back before, at a time when the market was more recognizable, I should say, because the COVID market has been just an absolute anomaly, both from the bullish perspective and then now from the bearish perspective, right? I think this is the worst start to the year really since the Great Depression. And this bull market was the fastest bull market in history. So both from a bullish and bearish perspective, it has been an unrecognizable market, right? So I think that if we break below those June lows, the next addressable and really psychological level support point would be the pre-COVID highs before we had this huge V-shaped correction. So that is where I would really look out to if we did break below those June lows. And if we get to that point, then yeah, I'll start selling cash secure puts pretty aggressively, because at that point you will be able to target a lot of the price points that we saw during COVID, during the March 2020 crash. But I think that would be a really great strategy, especially as IV would be elevated at that point and price points would be low enough to where the lower strikes on those cash secure puts, you would get paid a lot of premium for them. And again, on the S&P weekly, you have that same bear flag forming. It's really very similar to what's going on the NASDAQ. It's just, again, the NASDAQ has more violent moves than the S&P on a day-to-day basis and a week-to-week basis. But we have that bear flag forming. We close below, then we would obviously close below that golden pocket on the daily. We would then be targeting those June lows, which, no surprise, is also support and resistance from back in September, October 2020. And below that would be the COVID highs, right? The pre-COVID highs on the S&P 500. So on the SPY, that would be around 340 was the pre-COVID high. And on the triple Qs, the pre-COVID high looks to be around 238, 239. So look out for those levels. Let me know down below what your TA yields, whether you agree with this, disagree with this. If you have any questions, let me know in the comments down below. I try to respond to each and every single one. Yes, even the ones about my hair looking like Doc Brown from Back to the Future. Subscribe to the channel, hit that notification bell if you want access to all of the trades and everything. Again, we opened up spots. Link is in the description below. Stay safe out there, traders. Peace.